I'm Brent Luce. I work here at Carnegie. I've been here about 2 years. This is Raz Pounardjian. For those of you who have not been to Carnegie College before, this is something that we do once a month. We have a variety of topics ranging from market updates to the last one was about how to help elderly people avoid scams. We've had discussions about local history from a storyteller, talking about the history of Euclid Avenue, and other things that we think might be interesting to our clients and prospective clients. Raz has been with the firm for 4 years?
2012, 5 years.
5 years. He's kind of moved up the ranks and is now helping manage portfolios directly. For those of you that know Ensign Cowell, he's worked closely with Ensign over the years. Raz is particularly skilled at market analysis, company analysis. He's a student of the markets, and he's a great asset to the firm, and he'll be, give you a lot of great information today. So, welcome, Raz. Oh, also
Thank you.
We have surveys. If you can fill out a survey when you leave, that helps us better serve you in the future for future Carnegie colleges. So we'd appreciate that too. I believe, are they going to be passed out, or are they on the back table?
Yeah, I'll pass it.
Okay, they'll be passed out to you. Thank you.
Thank you, Brent. Thank you. Thank you, everyone, for being here. As Brent noted, I've been here at Carnegie for a few years now. I'm a local Clevelander. I went to John Carroll University. I still live in Cleveland. My family's here. I was born and raised here. So I get to kind of break down the market update into 3 parts, kind of just give a general market update from kind of more of a top-down perspective, kind of talk a little bit about politics, the new administration, how that will affect the economy and the markets, and then talk a little bit about market sentiment and just kind of put that into context. So it's going to be kind of a 3-parter, and some of the slides I'll go through a little quicker, some I'll go through a little slower. And I think at the end, we'll do like a Q&A session for those of you who have questions. So first, I will start here. This is a chart of the S&P 500 going back to 2007, you can see. And you can see the market is at or near its all-time highs. So the market has been actually pretty tranquil for the last few months, especially considering that we're seeing improving economic data. You may ask yourself, well, why are the markets hitting all-time highs? Well, you're seeing improving economic data not only here in the United States, but abroad, especially in Europe. The expectation, especially since the election, of lower taxes, less regulation, potential for increase in infrastructure spending, an increase in animal spirits, and that kind of ties into the market sentiment piece that I'll talk about later. Just a couple quick facts about the S&P, the market in general. We've been within 1.5% of our all-time high for 75 straight days. That's the longest streak since 1964. Also, the S&P 500 has not had a 1% intraday decline for 100 trading days. That's the longest since 1995. So just speaking about the general tranquility of the markets, those are just I thought, some pretty interesting statistics. Speaking about the economic data and why the market continues to move higher, here's just some quick economic slides that I'll go through. This is the Michigan Consumer Confidence. It's a survey that's done on a monthly basis from the University of Michigan, and it measures consumer sentiment. As you can see here, as I've circled, consumer sentiment is at its highest level since about the year 2000. So as you can see here, consumers are feeling good. And when consumers are feeling good, it means they're probably spending money, they're working. So this is a good sign for the economy. Unemployment is near a cyclical low. As you can see here during the recession, the last recession that we had, unemployment hit about 10%. Here we're at 4.7%. We'll be getting unemployment figures, I think, at the end of this week. But typically, this is as good as it gets, as they say in economics. You'll never have zero unemployment. You will always have some sort of structural unemployment. But typically, when you're in the range of between 3 to 5%, that's as good as it gets. And as you can see, since 2009, unemployment figures continue to decline. So more people are working, which is good. Wage growth, so the people that are working, continues to accelerate, and this is since 2013. So this is just in the last few years. You can see that wages can, as wages move up, people are getting paid more. It's at around between 3 and 4%, which is higher than inflation. This is a year-over-year figure. So wages are growing faster than inflation, which is, again, a positive sign for the economy and for the consumer. This is CPI, so this is a measure of inflation. And this is a very long-term chart going back to 1915. But as you can see here, I wanted to highlight, since 1984, inflation has essentially been in a downtrend. And that's coincided with interest rates declining during that same period. And there's a few reasons for that. One of which being technological innovation has lowered the prices, more efficiencies in the economy. As you can see here, recently inflation has ticked up a little bit, but it's still around its normal, still slightly below actually its normal range. It's at about 2.5%, which is, I believe, where the Fed wants inflation to be. So as you can see, the price of goods has not skyrocketed like it had in the past, and it's pretty tame looking at it from a historical point of view. Household net worth, this line I drew is from 2008 till today. You can see that since the recession, household net worth has increased. Why? Consumers are paying off their debt. The prices of homes are increasing. Existing home sales just hit a 10-year high. And also you've had the stock market recover since 2009 to all-time highs today. So you've had a combination of deleveraging and increasing asset values. This is the ISM Purchasing Managers Index, PMI. This is just a kind of a gauge of the manufacturing industry. And as you can see here, it's at 57.7. It's nearing a point where it was in 2010. So the manufacturing sector, a lot of the data I've been showing you is in relation to the consumer. This is in relation to manufacturing and quote-unquote the industrial economy. That too has been improving since 2016, which again is positive for the economy and for the markets. Interest rates, this is what they call the yield curve. So this is the green line is where interest rates currently are, and the yellow line is where they were a month ago. So as you can see, short-term rates here, these are T-bills, 1 month, 3 month, 6 month T-bills. Those short-term rates are increasing faster than long-term rates are. Why is that? Because of the expectation that the Federal Reserve is going to increase rates here in March, and the expectation is that they do it 4 times in 2017. It remains to be seen if they'll do it 4 times, but it's an expectation of that. And the market seems to believe that the Fed will indeed raise rates this month, short-term rate. And when we talk about raising rates, it's the Fed funds rate. The Fed funds rate is the rate at which banks who are part of the Federal Reserve System, the rate in which they can borrow funds with each other. So that's what the Fed funds rate is. Now, we talk about valuation, and looking historically, this is the CAPE ratio. This was developed by an economist, Robert Shiller. And CAPE stands for cyclically adjusted price to earnings ratio. And this is a ratio of the price divided by the average earnings over the last 10 years, adjusted for inflation. As you see where we are currently, we're at we're still below where we were in 2000 and in 1929, but it's at a high point. So, what does this mean? And should stocks be more expensive today than they were historically? And here is a case for, yes, stocks maybe should be more expensive than they have been historically. Why? You have better accounting standards. You have Reg FD, which requires the disclosure of material information to all investors at the same time. So when a company decides they want to buy back stock, they don't just tell certain investors. They have to release it to all investors at the same time. That was created in the year 2000. So before that, this was not in place. We're a wealthier and more efficient country. I mean, think about Amazon. You can go on your phone right now and with one click, purchase almost anything you want. Your iPhone has essentially replaced the Kodak camera. It does so much. Netflix, at the click of a button, you can watch most any TV show or film that you want to watch. Uber. If you get bored of this presentation, you can order an Uber, and you'll be out of here in 5 minutes. Also in this country, here specifically in the United States, we have rule of law. We have respect for contractual agreements, patents. If you infringe on someone's patent, you can get sued for that. And we also have shareholder rights. When you buy stock in a company, you have votes on the company matters. Other countries who have much more government intervention with their state-owned businesses, you don't have that. So here in the United States, you pay, quote, a premium for that, for those rights. In 1996, there were 8,000 publicly listed stocks. Today, there's about 4,500. So there's a scarcity value. Also, there's less publicly traded companies out there in the stock exchanges. The 401k is still relatively new. It was created in 1981. Every week or every 2 weeks or every month, there's over 100 million households who are putting money into their 401k, investing for retirement and for the future. And also transaction costs have declined dramatically. I mean, I remember as a kid when my father bought me stocks, doing transactions, I think it was at one bank, it was $50 for a commission. Schwab and Fidelity recently just lowered their trading commission cost to $4.95 a trade. So the cost of trading and just transactions in general have declined dramatically. So what does this all mean? Yes, the market historically is expensive, but doesn't mean it doesn't mean it's going to just go down from here. You're likely to have lower long-term equity returns, though. The annualized return of the S&P 500, the stock market, ending in 2016 over the last 5 years is 14.6%. That's incredible. It's probably not wise to expect returns like that over the next 5 years. I could be completely wrong, but if you were to take a guess, I would think that you're probably not going to see those kinds of returns over the next 5 years. Markets can also remain expensive for a long period of time. As you saw in those previous charts, the markets did stay expensive and over their long-term means for years and years and years. And calling market tops or bottoms is impossible. I think it's a lot of false precision when you have prognosticators coming out there and saying this is a market top, it's going to crash. I think it's somewhat irresponsible. And I think it's really hard to do that because you're trying to predict human behavior, and that's something that's really difficult to do. And I just want to point this chart out. This shows you all the bear markets in the S&P 500. And a bear market is a decline of 20% in the S&P 500. So you see all the drawdowns here, and you see some valuation figures, the 10-year Treasury yield, dividend yields, the inflation rate. And the point I want to make is there's no one indicator of when a bear market is going to occur. Look, you had bear markets when dividend yields were 6% and when they were at 1.2%. You had them when the market was trading at 9.5 times earnings and when they were trading at 22.8 times. You had it when interest rates were really high and when interest rates were really low. So it's very difficult to predict. And if anyone tells you, well, you can make predictions every day and eventually you may be right. So this I just thought was a really, really interesting chart that shows that it's not easy.
Raz, what is the CAPE ratio?
That's the cyclically adjusted price to earnings ratio. So it's the PE price divided by earnings adjusted for inflation.
Raz,
Yeah.
are there any common denominators, digging into those years?
One piece that we've read is that typically the drawdowns are much higher when you have a more expensive market. But just because the market is cheap doesn't mean that it can't have a bear market. So if the market's cheaper, you may not have a 40% drawdown. If it's more expensive, you may have a 45-50% drawdown like we did here in October of 07. That is one key point, but it still isn't a common predictor of when it will happen. Bear markets will occur, as you can see here, with that chart. And this is just bull markets over time. And I'm just trying to put into context the historical bull markets the S&P 500 has had. And the red is 2009 to today. And as you can see, 1982 to 2000 is all the way up here to the tech bubble. 1942 to 1966 is right here. And 1921 to 1929 is right there. So while it feels like, this bull market has been very strong, historically, it's actually, of the 4 bull markets we've had, it's the weakest. Now I'm going to move on to the Trump administration and more of the political side of things. And I'm not going to really talk about social issues or societal issues. I'm trying to focus on what will affect the economy. While the victory obviously was surprising to some, general investor mood has improved, and we'll get into that a little bit later when we talk about market sentiment. And you may ask yourself, well, why is the mood improved? Well, there's going to be potential for lower individual and corporate tax rates, loosened regulation for banks and businesses in general, increased defense and infrastructure spending. $1 trillion is the number that's been thrown around, and it's still very early. We don't really know what the actual plan or bill is there. Better trade agreements, and something different. Obviously, it doesn't take a rocket scientist to figure out that Donald Trump is not a typical Washington insider candidate. He is someone that is very different. And I think, we think that was, somewhat appealing to investors. And some may have felt that if the other candidate had been elected, it would have been just more of the same. So this is something that is different. I'm just going to touch on the ACA, the Affordable Care Act. The proposal to repeal ACA or Obamacare and implement a new system was revealed on Monday. From what we read in the research that we see, you have 20 million who are currently insured under the ACA. To repeal that completely and not have a replacement is very unlikely. It, probably be political suicide. So there's going to be some sort of replacement. So on Monday, when they released the proposal, these were some of the key points of that proposal. And the first one being continuing to support those with pre-existing conditions, do away with the individual mandate, but include refundable tax credits, the ability to shop across state exchanges. Republicans believe that may actually decrease the costs. Increased use of health savings accounts, HSAs. Increased subsidies based on age and cap tax breaks for individual employers who provide employer-insured health insurance. Eliminate the ACA rule that requires employers with 50 or more full-time workers to offer them coverage or pay a penalty. After the proposal came out, you start to get everyone's analysis. Well, will this pass Congress? Who likes it? Who doesn't like it? And after what we've read and what we've heard, I think it's best explained by what Nancy Pelosi said in 2010. We have to pass the bill so that you can find out what's in it. Because there's just so many moving parts. There's some House Republicans want to just completely repeal it. Some Democrats obviously don't want to repeal it. So there's a lot of moving parts, and it's still very early. Tax and regulatory reform. Trump's proposal is to reduce personal income tax rates and simplify the current tax code that we have from 7 to 3 brackets, 12%, 25%, and 33%. Increase the standard deduction from $6,300 to $15,000 for single filers, and increase it from $12,600 to $30,000 for those who are married couples filing jointly. They would like to cap the itemized deductions at $100,000 for single filers and $200,000 for married couples filing jointly, and culling personal exemptions for dependents and those as head of households. So there's a little give and take here, and similar to the ACA proposal, this is not yet finalized. This is just a proposal, and it remains to be seen how this will end up. The border adjustment tax is something you may have heard of in the news. The border adjustment tax is a proposal where companies that source and get their products from overseas and then ship them to the United States and sell them in the United States, they would pay a tax on that. So that would hurt a company like Under Armour or a company like McCormick Spices, who source their raw materials from the equator and from tropic countries. And so they source their ingredients and their raw materials, ship it to the United States, and they mostly sell it here in the US. That could, that would hurt a company like that. But Commerce Secretary Wilbur Ross has noted that he remains skeptical about this. So this, again, is and the reason, from what we've read, that the border adjustment tax is out there is first to, the America First theme, keeping jobs in America, manufacturing, buying American products. But number two, it's a way to, raise taxes and incentivize companies to do things in America. Larry Kudlow yesterday noted that he felt that Wilbur Ross wasn't very supportive of this, and this won't be a make or break issue when it comes to tax reform. So even if the border adjustment tax isn't passed, you still will probably see just general tax reform. Corporate tax reform could get done in 2017. Domestically oriented companies would benefit the most. The proposal is to cut corporate tax rates to 15%, but our research believes that Congress could settle for about 20%. And here on the next slide, I want to show you, this is the OECD, which is the Organization for Economic Cooperation and Development. It's a group of developed countries promoting the economic and social well-being between them. And as you can see here, countries like Belgium, Australia, you see Japan, Germany, Mexico, large developed international countries. You see their corporate tax rates, and you see the United States. And then the red line, excluding the United States, is the average corporate tax rate of those countries. So they're at 25%, and the United States is at 39%. So one of the reasons the market has been so positive about the election of Donald Trump is because if companies have lower tax rates, they'll have more money to spend, they'll have higher profits, they can do so much with that money that it's been a real positive. So this is something that we believe is going to be could be very positive for not only U.S. corporations but the general U.S. economy. Just to kind of wrap this up, the proposal on ACA that just came out on Monday, we're probably going to see action on that before tax reform. ACA is likely going to be tackled first and then tax reform next. Lower taxes are positive for both corporations and individuals. When you have more money to spend, they call it the permanent income hypothesis from Milton Friedman. When you expect to make more money, you spend more money. And think about it. If you're someone who takes an IRA RMD, if you're paying 20% federal taxes and your RMD is $10,000 and you're paying $2,000 in taxes and your rate drops to 15%, there's an extra $500 in your pocket that you can save, spend, do whatever you like. So it can have a very stimulative effect. And remember, US GDP, about 2/3 of it is consumption. This is a consumption-oriented economy. And animal spirits are good for growth. When people are feeling positive and they're out there spending and they're feeling good, that's good for the US economy. Interest rates, as I mentioned earlier, likely to move higher. You're having momentum in the housing market, as I mentioned. The existing home sales are at a 10-year high. Potential for infrastructure spending, and you have an improving economy. The infrastructure initiatives, from what we read, may not take place until 2018. Details around the repeal and dismantling of Dodd-Frank, which were the regulations that were set forth after the financial crisis of 2008. That's still murky, but it would still be a positive for financial institutions and businesses when you're spending less money on compliance and regulations. A lot of bank CEOs have come out very positively and said that regulation is going from a red to a green. So it's going from something that was a negative and a drag to something that's positive. Potential for repatriation of overseas profits. That seems more likely to pass before tax reform. There's about $2 trillion sitting overseas. That's a lot of money. And the question remains, what terms and how would the repatriated funds be used? You know, this last happened in 2004, but the majority of the funds were used for share buybacks. So potentially maybe the Congress or the president says, we'll repatriate these funds, but you have to spend it on X, Y, and Z. What X, Y, and Z are is still uncertain, but that too could be a positive for U.S. corporations in the economy. Now I'm going to talk about market sentiment. Market sentiment measures how good or bad, in the simplest sense, people feel about the equity markets. So this is the Investors Intelligence Sentiment, and this blue line is the percentage of people who are feeling bullish about the stock market for the next 6 to 12 months. These figures are calculated based upon market data and a survey that's done by the American Association of Individual Investors. And every week, they ask their constituents, are you bullish, neutral, or bearish on the U.S. stock market in the next 6 to 12 months? And what I want to do is kind of contrast how negative everyone felt in February of 2016 when you had China slowing down, oil prices going to $20. People were worried that the U.S. economy was going to tip back into a recession. And now, look where the figures are. It's at its highest point since 2005. So people have gone from very bearish and negative to very, very bullish and optimistic. This next chart shows you the amount of people who are bullish minus those who are bearish. So those who are saying I'm very positive about the market versus those saying I'm very negative about the market. And it's very similar to the last slide. Down here, January of 2016, the amount of those saying that they were bullish was at its lowest point in history. And right here you can see the bulls minus the bears was a negative figure. And here it's creeped right back up and has gone back to being optimistic. So as you can see here, part of the reason why, again, the market continues to move higher is people are feeling more optimistic. They're feeling good about the economy and the stock market in general. I want to end with just a few positive facts about the world. For the first time ever, less than 10% of the world's population lives in absolute poverty. You know, so much of the news that we hear today on social media and on TV, some of it can be very negative, and I'd just like to share some positive facts just about the world. Since 1950, the average IQ has increased by an average of 20 points, so we're smarter. For the first time in history, more countries are democracies than dictatorships. There's less war than ever before. So, just some positive things to think about, and I'll end with some quotes to remember. Never bet against the end of the world, it only happens once. Ben Graham was the teacher of Warren Buffett. They call him the father of value investing. Markets can remain irrational longer than you can stay solvent. That's John Maynard Keynes, who's a very famous British economist. The most powerful force in the universe is compound interest, Albert Einstein. And then lastly, American author John Updike. We do survive every moment after all, except the last one. That's what I saw. Thank you. Questions?
Raz, that was great.
Thank you. Thank you.
Raz is great. He's my.
Thank you.
But I'm curious to know what market sectors Carnegie Capital is looking to overweight and underweight in these times.
You know, while we typically, when we look at companies, we look at it from a bottoms-up point of view. We do look top-down, but we're looking for the best companies trading at reasonable valuations that we can buy. And there are times where certain sectors, for example, you know, early last year, energy was an area where it wasn't very liked. It was reasonably valued. That was an area where maybe there were more attractive opportunities than others. In terms of overweighting and underweighting, where we stand right now, I'm not sure we're making, big sector bets either way. We don't drastically overweight one sector and then underweight everything else. I would say that we're, we may be a little underweight certain places, a little underweight other places, but it's nothing that's, we don't make large bets one way or the other. That's not, I don't think that's really the goal most of the time.
Thank you.
Mm-hmm.
Since regulations for banks are being lessened,
Mm-hmm.
do we trust the CEOs to not do what they did in the housing crisis?
Yeah, that's something that is a case for regulation, and I think the way we kind of view things, it's kind of like the market. Things go to extremes. Before 2006, you didn't really have a lot of regulation. You didn't have a lot of oversight in the housing industry. Now it's gone the other way. There's too much regulation. Banks are forced to hold more capital than they need. They've been more restrictive in terms of the loans that they can give. So it just depends about how much they can roll back the regulations that that are in there. And I think many of the CEOs, we would hope, learn their lesson and won't make the same mistakes. But that's probably something that can be answered more on an individualized, company by company basis. Some banks are more conservative than others. Others may be more aggressive in terms of the loans that they make or who they're willing to lend to. So it's more of a matter of what from what we read, is Dodd-Frank going to be completely repealed? Maybe, maybe not. Maybe there still will be some restrictions, but it just won't be as tight as it's been over the last few years. Yes?
Dodd-Frank, I don't think provides for CEOs going to jail like the Glass-Steagall did. And then when Father Bush was in office, that mortgage problem, 1,000 people went to jail over that disaster. So nothing happened, I think, but one person in the 07-08.
Yeah.
If the Dodd-Frank doesn't have any provisions for the upper echelon to go to jail, that's a really weak spot. I don't know what they'll do. But
Yeah.
the lobbyists, they might not be able to do anything.
Yeah, yeah. I'm not trying to cop out, but it's just still very early. We just don't know. I don't want to sit here and just give you an answer because it's just there's still a lot of uncertainties in terms of what regulations, what will be rolled back, what won't be rolled back, what will be put in, what won't be put in. It's still pretty early in the game. But the CEOs, especially in the banking industry, have spoken very positively about if you did roll back regulations, this would be very good for us. So I think that's a net positive.
How does all this apply to northeastern Ohio?
Northeastern Ohio, that's a good question. I would say, we have a few industrial companies here in in Northeast, Eaton, Parker Hannifin, Lincoln Electric. If in the United States we continue to, if we see lower corporate taxes, those corporations will likely benefit from that. Maybe they'll be out hiring other people. Reduced regulations will help a company like Progressive potentially. And just speaking in Northeast Ohio in general, you've seen Cleveland, the city of Cleveland, just blossoming. If any of you have ever read Brent's Carnegie Market blog, a few times he's talked about how apartments downtown have just increased dramatically in value, how occupancy rates are above 90%. The city of Cleveland itself has completely turned itself around over the last 10, 15 years, and I think that's a net positive. You're seeing a lot of restaurants, you're seeing this millennial class move downtown. They're moving towards the city and not, and away from the suburbs. So, I think Northeast Ohio in general should continue to do well.
Actually, there's no real reason for them to. There's no U.S. Steel or a big company like that.
Yeah.
That's a fire in the furnace, so to speak.
Yeah.
There's healthcare though.
Yeah.
Our two biggest
Yeah.
employers are the clinic and UH.
Yeah.
And then those are bringing, like IBM is building a new facility down there, and that's a tech company, but it's feeding off of healthcare. So that's
Yeah.
there's a lot of derivatives coming from
Yeah.
healthcare,
Yeah.
and things like that that are different than in the past.
They say eds and meds, education, you have great universities here in Northeast Ohio, and meds, like you said, Cleveland Clinic and UH. So those have been real drivers.
How
Yes.
do we invest in the millennial demographic?
Millennial demographic. Well, first, we think it's good to look at what are millennials doing? How are their habits different from previous generations? So as I mentioned there earlier, you see things like Netflix, you see things like Uber, you see things like Amazon. So areas of e-commerce, areas of a shared economy, areas of artificial intelligence. Millennials, I was listening to a podcast on Saturday, and for the first time, more millennials have Netflix subscriptions than they do cable subscriptions, cable TV subscriptions. So that should tell you how there's a huge shift that's taking place. And so areas of technology, areas that can make life easier for consumers. Nowadays, Brent and I, every day, we go across the street, and when he pays for the drinks that we buy, he just takes out his phone, scans it over the card reader, and that's it. So, things like that, I think, we're moving in that direction, so.
Brent's
Joe.
not a millennial, though.
Yeah, exactly.
I act like
He acts like one, exactly. Joe.
Raz, I wanted to dovetail on that gentleman's question. As you know, I'm in the business of business real estate. I was
Yeah.
with Austin Dorff Morris, business real estate company, prominent here in Northeastern Ohio for 30 years. And now I'm associated with Hannon Commercial Real Estate. And it's more than meds and eds. This area is very strong. As a matter of fact, the industrial real estate market, which is manufacturing, distribution, warehousing, high tech in the 6-county area, has the absolute lowest vacancy rate that it's ever had. It's
Yeah.
almost frictional, like unemployment.
Yeah.
We're down to about 5%.
Yeah.
And a lot of we don't have the steel companies anymore, and we do have the meds and eds, but there's a lot of companies here that are growing and producing and distributing, and
Yeah.
the area is very strong.
Yeah, I agree. I
You
agree.
said there's more smaller, it's a lot more smaller companies than it used to be. It used to be driven by a number of large.
Well, it's across the board, really. You've got the large companies here. Now, you don't have all the old dinosaurs that we used to have when I was growing up. No, when I got out of college in 1970, I'm 68 years old, Cleveland was number 2 for Fortune 500 headquarters. We were above Chicago, right behind New York, and we don't have that anymore, but there's a lot of entrepreneurial companies, middle sales companies that are, have grown out to Streetsboro, Twinsburg, Aurora, areas like that, and Westlake, and it's very strong. And the Cleveland industrial market is still one of the largest in the United States, about 14th, even though when I was a kid, we were the 6th largest city, and now we're probably 35th,
Yeah.
and the metro area is probably still around 26 or 7.
Mhm.
It's a pretty strong area.
Yeah.
So we see a lot,
Yeah.
so.
Yeah. Well, we've definitely, we believe we've really made a strong comeback. The city of Cleveland itself and reinventing itself, and what's happened here in the last few years. It's definitely been very positive.
Doesn't feel that to me.
Yeah. Yes.
Sweeping generality from the,
Yeah.
it would seem that a disgruntled, perhaps underpaid population
Yeah.
fed this election.
Mhm.
But yet your information seems to say that it's counter to that,
Mhm.
that everybody's making more money at higher rates than ever before. So who were those people?
Right.
We don't like to make, like you said, we don't like to make sweeping generalizations, but just, when you go out and drive in rural areas, we live, we're here in mostly suburban areas. When you go out and drive in rural areas where their steel factories have been closed, like, we talk about U.S. Steel, and we talk about how these were the largest companies, 70, 80, 90 years ago, and now they're just a fraction of what they were. A lot of these rural areas where they had coal, mining, steel, where their factories have essentially been shut down or eliminated, they feel as if maybe they were left behind. And so they feel as if we want something different. So maybe that, led to the
So you're
to
saying
the results.
basically the rural impact was greater than.
Yeah.
Say, and I it's a good
Yeah.
answer.
Mhm. Anything else? Nothing? All right. That's all. Thank you. Thank you.